Thanks, Jason. Thanks, Mario. I want to especially thank Mario because sometimes I'm getting up in the morning to go do these in Toledo, and I actually live one exit away from here, so it was nice to not have to hold my breath and hoping to get too much snow, but only get one exit away. We looked at what Mario asked me about what my topic was, and Jason went over sort of a whole spectrum of valuation metrics. What I'm going to focus on in my presentation is looking at, again, specifically if an owner decides of a business that they're ultimately going to transition through a sale, and walk through some of the concepts and things that we go through as part of that. And as Mario said, I'm John Herubin with Edgepoint Capital Advisors. We're based in Beechwood, and we've been around since 2000. 12-person merger and acquisition investment banking firm. And we work, again, although we're based here, we actually work all over the country working on deals. And when we look at transition, to us, 80% of what we do is representing owners in a sale or transition. And sale to us, could be sale to outside third party, sale to management, a recapitalization where you might bring in a partner, private equity as a sale, or an ESOP. We do a lot of work in ESOP. So to us, anytime shares are moving hands and money is exchanging hands, we can help facilitate that transaction. We also represent buyers, so we think that gives us a unique perspective. Not a lot of folks in what we do will represent buyers, and our market is what we call lower middle market companies. Companies generally 5 to 150 million in revenues. So that's primarily companies that are closely held family businesses. All our backgrounds in the firm are, most of us are recovering CPAs or attorneys, so we've worked in that environment and spent our careers. A number of us have owned businesses or advised closely held businesses in our career. So that's kind of our focus in what we do. We generally close about 10 to 15 deals a year. And as like I said, we're working all around the country. Actually, several times a year, we'll work with foreign buyers on deals. So we're actually having discussions about value and preparing for exit with people all over the place. So we're engaged in many conversations. So we think, again, that gives us a good perspective on this process. Right now, we have 20 active engagements. So on the first couple pages, as I just said, as Jason said, the commercial for us, you'll see some of our senior leadership. One of my partners, Dan Wyman, has joined us here today too. And our practice focuses a lot. You'll see again on page, I believe it's page 4. We work primarily in manufacturing and industrial related companies, but we have a lot of experience in business services, distribution, rail. You'll see a lot of automotive, chemicals. So we have a fairly broad spectrum of industries we work with, which again we think gives us a good perspective on what buyers and what people in the market are valuing businesses in these general types of companies are these days. I'm going to flip ahead to let's see, it's looks like it's page 8. This is part of a larger presentation we typically do, which goes through sort of the preparation. And that's, again, when we talk about the theme of today was preparing your business for exit. We're going to talk about the sort of the upper part of this slide. And it's, what are some of the objectives that owners have? What are some of the things you should think about with regards to a company and getting it prepared? And then what do we do and what does your team do as part of that? And again, hopefully you won't get the sensation of sipping water from a fire hose in this, although I think that would probably freeze today if you tried that. In our minds, just to give it a context, we're asking 3 questions. Is the owner ready for this type of transition? Is the market ready for this type of transition? And then is the business ready for this type of transition? And when those 3 aspects intersect, then it's it's probably an optimal time for an owner to strongly consider doing that. So as we go through this, I'm going to highlight some of the, and we look at it, Jason had some of the mathematical and theoretical things that go into valuation. I'm going to highlight, we're going to talk about some of there's quantitative parts of that, but there's also qualitative things that go into that decision and how we approach that. We have a partner that says the soft issues, the huggy issues. On the next page, a lot of times for owners, when they get to that point, if they're considering transition, sale as a possible transition, there's definitely more questions than answers when they get started. And as we sit down and talk to people, we try and help them in that, are they ready for this process? Is the owner ready? Some of these questions are, what are they selling? Is it their core business? Is it part of their business? Is there certain divisions or things they do that could be sold? Do they want to own, if they own their real estate that the business is in, do they want to keep that? So those types of things might be swirling around in their mind. Why are they selling? And this gets to that qualitative aspect of it. Are they looking to retire? Do they need cash out to retire and meet some financial planning goals or retirement planning goals? Is there industry, or is there something external causing them to do that? Is there consolidation that might, they're wondering about? There's quality of life issues. We've had times where an owner's perfectly happy running their business, but a spouse gets sick or a child gets sick, and life circumstances change, and they want to consider this. How should they sell? People who don't do this all the time, we meet with a lot of owners that are great at bending metal or moving their product around, but they've never done this before. So when you start talking about asset sale, stock sale, contingent payouts, earnouts, equity rollovers, there's a lot of very confusing terminology that goes on around this, and a lot of owners will opt to not deal with it and stick with what they know and what they feel comfortable with. So answering that question, that's kind of what we do, is we help with that. Who do I want to sell to? We talk to a lot of owners that have competitors, which would be a strategic buyer that they may want to buy or sell the business to. Management. They say, what, I wouldn't have what I have and the value of this business if I didn't have such a good management team. So I really would maybe consider getting some ownership to that group. Private equity. You'll hear a lot about that, at least in our world. Private equity has been a very, and I'll spend a little bit more time on that in a couple minutes. But do you want to sell to somebody who is just looking for a company to buy and invest in? ESOPs. Again, back to that concept of my employees have helped me get to where I'm at today. Do I want to share that ownership with them as part of the transition? And as I mentioned, international buyers come into it, which a lot of owners don't always consider. And then the next important thing is, when do I sell? When do I want to do this? And that gets to the planning and some of the planning concepts we'll talk about when it comes to, is the business ready for this process? On the next page, we talk about is the market ready? And it seems self-serving to say for us, but I've been in this business about 20 years, and some of you might have been around longer than that. I've never seen a better time than right now to at least be considering this and for the market. I still think there's been a better time in the last 20 years. Why do we say that? One, we know there's a tremendous amount of activity going on. We've never been busier since we've been in business and started in 2000. And there's a number of factors for that, but the main ones, and this isn't in any particular order, but interest rates right now are historical lows. They're not going to get any cheaper. And I think there's a mix of professional advisors and owners in here. So there's some folks from banking, but banks, it's certainly not the heady days of '06 where cash flow lending was like the Wild West and businesses were getting financed. But banks are back to being more aggressive and have cash to lend into deals to help get them done. So there's availability of capital through banks. Capital gains rates are low. There was a big budget fight a couple years ago, and cap gains rates went up, but didn't go up as much as I think people might have feared they would have, which might have dampened activity. So capital gains rates are still generally at a historical low. Capital availability and supply of money. When you look at who potential buyers could be, a lot of publicly traded companies have stockpiled cash through the recession. So strategic buyers have a lot of cash on their balance sheet, which is dry powder for them. The economy hasn't been growing by gangbusters, so there's a lot of businesses that have to grow. If they can't grow organically, they're going to look to grow through acquisition. So there's an active buyer pool created by those companies that have that type of cash. A couple other points here. We talk about a third factor is there's a large private equity overhang. And this goes back to that supply of money. And this, I think, is a unique factor in today's market, is that private equity could represent anything from two individuals throwing money in a hat to say, let's go buy companies, grow them, sell them for more than what we paid as an investment, up to large endowments and pension funds and professionally managed, publicly traded private equities. But across that whole spectrum, their idea is that they will buy companies, grow them, and sell them for a return. And because there's less ability to grow that in the public markets, there's a lot of that money is looking at lower middle market companies, smaller companies that wouldn't have been on their radar a number of years ago. So they're not getting the returns they wanted from larger companies before, so they're looking now at a lot closely held companies to do that. And there's a certain cycle to how this private equity has raised money over the years. They generally would raise money for a period of time, buy companies, hold them, grow them, sell them, raise more money, and do it again. Well, the recession threw a wrench into that cycle. There was a lot of money raised, but there wasn't a lot of businesses worth buying during that period. So money stockpiled in these groups, and so there's sort of a lot of pent-up demand in these groups for businesses. And then fundraising through additional groups has grown significantly over the last several years. So, bottom line is there's just huge pools of money out there looking to buy companies. So that's another, factor that's, contributing to a very active market. And then companies just in general are doing better. Again, not gangbusters, but there's a lot of owners now that look at if they were 62 when the recession started and they've had to kind of dig out of that hole for the last 5 years, they've kind of gotten back to where they were, and now they're 67, they're saying, you know what, I'm not going to miss this cycle. I really want to consider a transition now. I don't want to, see what's going to happen, no one knows what's going to happen a year or 2 years from now. So there's a number of factors that could affect that. So they're looking to possibly get out and consider an exit today. And then industry consolidation, and there's some other ancillary things. So from our standpoint, when we ask, is the market ready? We think that's today is a resounding yes. And there's a couple slides supporting some of the statistics behind that assessment on our part. When you move over to page 14, we're kind of moving back to the owners and really wanted to give you a snapshot as to, again, we have hundreds of conversations with owners, but there's some common themes. Families are different, businesses are different, and ownerships are different, but it seems the priorities and the concepts around what their priorities are seem to repeat themselves. A pattern develops. So a lot of business owners, seem to fall within the way this pattern is. Their goal or objective, if they decide to go down this sale process, is do they want highest price, or they would like a highest price for their business. Some care about preserving their legacy. The company is very important to them or family. If it's multi-generational, might be important to a community. Another one is they want it to be employee friendly. A lot of people, and we deal with folks in some smaller communities, they're worried that, if I sell, I don't want this business moved. There's 250 families that rely on, a paycheck. I don't want to consider that. So, I want my employees taken care of in, whatever happens on the other side of a transaction. And then another concept there is confidentiality. Again, entrepreneurs are typically very, very private with their business, and they worry about keeping things confidential and not having everybody know their business. And so it could be one of those objectives. Generally, it's some crossover between one or two of these. On the next page, based on more often than not, highest price ends up being part of that discussion. And here, just again from a snapshot and based on numerous discussions we have, here's some of the things we see today when we talk to buyers that are most important to. And again, I go strategic buyers are people in an industry that the same industry as our client seller might be, or financial buyers, which are those private equity groups that are looking to invest and grow businesses. And some of the more important aspects in preparation in deciding whether the business or the things that affect value when we talk about that, and then we'll talk about how you prepare to meet these things are, is there strong opportunity to grow sales in the company? So private equity and other buyers, they want to buy growth. They want to see expansion over time. So that's always important, in those discussions. Is there recurring revenue? Is it a business that will have the ability to continue producing consistent revenue over time? Is management capable? Or is there a strong management team behind the owner, or is the owner still the main person running the business so that customers call them all the time? They're out on the floor, they're answering the phone. They spread out their management team to help run the business. Is there any proprietary or patented technology in the business that would make it difficult for a competitor or somebody to compete with them? Are they in a defensible niche or segment? They possess something unique that a process or a relationship that would be difficult for somebody to replicate. Do they have long-term contracts, which in a lot of instances seem to be less and less prevalent? Customer concentration. If you have a great business, a very profitable business, but 90% of it resides with one customer, that's a risk point for a buyer. That'll affect how they view value, because as we saw in the recession, even long-term relationships disappeared. So customer diversification is also an important factor to buyers. Are there acquisition opportunities? As I mentioned, the organic growth has been stunted, at least in the more recent times. So are there opportunities to acquire additional businesses by that buyer? And then for us, value, to get highest price, going through a competitive process, helps drive up value for the owners under these circumstances. So I've talked about things to assess, that we assess when we look at whether is the owner ready to do this. We've talked about is the market ready, and we think it is. So the remaining slides, I want to talk about some things that we often advise our clients on. And there's a lot of clients we work with that we start talking to them several years before they actually decide to pull the trigger and go through a formal marketing process to sell the company. So these are the things we'll talk to someone about if they say, well, I'm not quite sure what the value is, I'm not sure when I want to do this. We'll start looking at some of these business concepts to see whether the business is prepared, so that when they do want to make that decision and move ahead, that the business is in the best position to achieve those value drivers that we talked about in the previous slide. So this is how do I get the company ready for sale? And the 5 concepts we have here, and there's others, but we look at the emotional considerations. There's operational, financial, legal, and tax, and sales and marketing. The first is the emotional. Again, some of these I've already touched upon. But people often underestimate. We have a lot of owners that often underestimate the emotional component of selling their business. There's a ton of anxiety involved in this process. My partner Dan Weinman has a undergraduate degree in psychology and an MBA in finance, and there's days you question whether you use your psychology degree more than you use your finance degree with owners, because it's an emotional roller coaster for a lot of folks. If you're a second or third generation business owner, there's a lot of emotional equity involved in that process. So, but we often find, though, knowledge is power. Fear of the unknown is often a paralyzing aspect for a lot of owners. And what we do is we help coach owners and shine light into the darkness. We look around those corners and say, we've done this literally hundreds of times. Here's what we've seen other owners do. And we kind of hold their hand and through that process, and we're kind of interpreters for a lot of the terminology and things they haven't heard of or experienced in this process before, and we get them through that through this process. So it's how do I, again, we talked about employees. When do I tell my employees as part of the process? What's going to happen to my family, the community, and the legacy. So that's we talk about those things. From an operational standpoint, which is the second component there, I mentioned earlier, a capable and strong management team is often very important to buyers with regards to value. So as part of that preparation process and planning process, we look at evaluating the leadership team. Are they capable? Who has the relationships in the business? When there's a problem, who does the customer call? Do they call the owner, or has the owner started to disperse multiple contact points in the business so that suppliers or vendors or customers or people on the floor, they're not doing everything. Dan and I met with a company recently, trucking related, where the owner has a couple hundred employees, but he's still crawling under trucks and going in the repair shop. And as part of this preparation process, we said you've got to pull yourself out of that day-to-day stuff and be more strategic. Start finding people on your team so that the value doesn't just reside with you, because a buyer will see big risk if they're writing a big check and the owner goes away and suddenly all those contact and all that knowledge leaves. So it's evaluating leadership, and those relationships are important. There's a number of ways to reduce operational costs. Well, I guess I'll step back on the management team too. Some people will, it depends on if they have an advisory board, but finding the right people who are committed. Some people think, well, my employees will just step up. Then when we find out, we might have conversations with them, and they're just perfectly happy being supervisors, on the floor or in a certain area. They don't want ownership. They don't want to have to worry about signing personally guaranteeing debt or loans with the business. So again, having those conversations in preparation helps identify the gaps where there could be gaps in that leadership. And again, it gives the owner time's their friend and enemy in this process. The sooner you start doing these things, the better position you are in for when you do decide to go down this path. So reducing operational costs, we'll talk about your supplier pricing terms, labor contracts, getting all that stuff looked at, cleaned up beforehand will help the business be better prepared. On the next page, we talk about optimizing operational ratios, inventory turns, making sure you got your hands around inventory, your days, your payables, get your payables lined up, your receivables, so that working capital in value becomes a important component at some point down the process. So we want to make sure you've got your arms around the working capital so that doesn't negatively impact value. So there's a lot of metrics that people can use to measure the efficiency of the business, and again, we help look at that ahead of time in anticipation of what we think buyers will look at and value there. Simple stuff like sell excess inventory. Entrepreneurs are generally very resourceful. So we were walking through a metal fab shop recently, tons of machines out in the maintenance yard, and we said, what are you doing with this? And the owner says, well, there's a part on this one I may use one time, so I got this machine at auction, I bought this one, and I'm going to use a little part out of it sometime. So they'll cannibalize stuff, which is great when you're running the business, but someone coming through isn't going to give you value for all this machinery sitting around. There's a lot of folks who have inventory. They'll set up tooling to make some parts. They may need to only sell 5 of them now, but since they have it set up, they'll make 100, and 95 sit in inventory. And they expect value from buyers when they come through, and they said, I can't tell you when I'm going to sell it, but someday I'm going to sell it. So it's kind of aligning those types of things for getting rid of the excess. Getting to the financial aspects and kind of move along here quicker. In helping due diligence, you want to have stronger financials. So value will stand up from a historical standpoint if you have good books and records from a historical standpoint. So what we do is we help, or we ask or recommend that people get, it helps establish credibility. So if you only have compiled statements, a lot of owners haven't had to borrow in the past, so they just use QuickBooks or their tax returns. So we recommend they go, see folks like Jason at Apple and get either an audit or a reviewed statement. It adds credibility for when someone's looking under the hood as part of that. We also say clean up the balance sheet. So if there's shareholder loans or things that are unique or have worked for the business in the past, but to someone else would be unclear, we recommend they clean that stuff up. I talked about working capital. Page 22, we have an overview of M&A deal math. And this is where, Jason mentioned earlier, cash-free, debt-free. There's a number of different ways that we value companies, discounted cash flow, leverage, taxes, depreciation, and amortization. Then people talk about multiples. What's the multiple? And it's more complicated than that. But finding depending what the buyer's multiple is, that comes up with an enterprise value. From that value, the owner pays off any interest-bearing debt. They keep the cash, the proceeds less tax, and the net proceeds they keep. It's not what you sell a business for, it's what you keep at the end. Multiples are a very dangerous thing in our business. Multiples have been up generally for businesses of all sizes, but we're selling two companies right now with the exact same sales and the exact same EBITDA. We went to a couple hundred buyers for one of them, and the multiple came back at between 4 and 4.5 times. The other business, it came back between 6 and 6.5 times. And it had to do with, the one business had greater growth prospects in an industry that had greater future potential than the other one. But the sales and the bottom line were the same. So again, that goes back to some of the qualitative things in a business that affect value. Page 24, we talk about, again, buyers pay for growth. So having strong historical information and then a credible forecast helps create, some comfort from a buyer's perspective, strong likelihood of future growth for what they're paying for. The next page, CapEx. Do you repair the roof, or do you put a new roof on? Do you buy that new machine or not? Because again, that will affect future cash flow for our clients, and we got to assess whether you're going to do that, those capital expenditures. Sales and marketing, again, another area that could, depending on the type of business, could be impactful for value. Legal and tax is the next section. Just make sure the books and records, and Mario can speak to this better, just make sure the books and records, the right shareholders are identified. We occasionally come across, there's no buy-sell agreements in a business. Grandpa gave his secretary a couple shares 50 years ago, and there's, there has to be a unanimous vote to sell the company. So you got to go find, this family member, and they think they're sitting on a gold mine. So I mean, just you've seen a lot more of this too, and so just making sure the books and records are clear. Who the shareholders are, things like that. Jason also mentioned when you talk about tax structure, S corp, C corp. We've helped folks save a lot of money just by working with their advisors on converting, to S corp or LLCs. A lot of implications around that. Stock sale, asset sale. Again, we work with the advisors to figure out how that's going to work. For multi-state businesses, make sure all the filings for sales tax and things like that are done. Again, all these things come up on, these are all issues we've seen with due diligence with buyers. When they see risk, they penalize sellers for value. I guess just the last point I'll make is on page, let's see, my glasses on here, looks like 30. It's the pre-sale preparation and how this EBITDA adjustment could affect. So when you do these add backs on EBITDA, there's a multiplier effect. So when you do some of these things we talked about, to help improve that cash flow or that EBITDA. In this, our example here, we found $600,000 of additional add backs or adjustments that a new buyer wouldn't necessarily spend. And at a 6x multiple, it's almost a $4 million difference. So these little things add up, I guess, is the punchline for that. And I guess lastly, I'll just, the last couple pages talk about assembling your team. And, we're big proponents of, again, certainly we want to be involved in that process, but talking to your attorney and your accountant ahead of time, and that preparation ahead of time will help, that piece of the pie where, again, is the owner ready, is the market ready, and this will help with the businesses ready. But your financial advisor, making sure you understand how selling a company is going to help your retirement plan. It all fits together. And again, we see the best outcomes when folks work with the team and to talk to someone earlier rather than later.